The physical silver market is separating from the paper silver market in ways that have not happened before. This is not a forecast. This is not a theory. This is already underway. Most retail investors will not see it until it is too late to respond. The mechanics are simple. The timing is not. What is happening right now is a structural shift in how silver is priced, who controls that pricing, and who will have access to the metal when the system resets. If you hold silver, or if you are thinking about holding silver, you need to understand what is being built beneath the surface. Because the trap is not designed to catch speculators. It is designed to catch anyone who waits too long to move. Before we go further, subscribe to this channel if you want serious coverage of precious metals markets without the hype. We focus on structure, not speculation. And right now, the structure is changing faster than most people realize. Silver trades in two separate worlds. One is physical, the other is paper. For decades, these two markets moved together. When paper silver went up, physical silver followed. When paper silver dropped, physical premiums stayed reasonable. That relationship is breaking. Physical silver is becoming harder to source. Premiums are rising. Delivery times are stretching. But the paper price is not reflecting any of this. The COMEX futures market still shows silver trading in a narrow range. The spot price still moves based on trader sentiment and dollar strength. But the physical market is tightening in ways the paper market does not register. That gap is the trap. Here's how it works. Most of the silver price discovery happens on the COMEX. That is where banks, hedge funds, and institutions trade contracts that represent silver. These contracts can be settled in cash. They do not require actual metal to change hands. This system was designed to provide liquidity. It allows large players to hedge risk and speculate on price without moving physical inventory. But it also means the price of silver is determined by traders who may never touch a single ounce. When you look at the spot price of silver, you're not looking at the price of metal. You are looking at the price of a contract that represents metal. And those two things are no longer the same. Physical silver, by contrast, is what you can actually hold. It is minted bars, coins, and rounds. It is inventory sitting in vaults, allocated to specific owners. It is metal that has been refined, shipped, and stored. Physical silver cannot be created with a keystroke. It cannot be settled in cash. It exists in finite amounts and it moves slowly. Right now, the physical supply is being absorbed faster than it is being replaced. Mints are running behind on orders. Dealers are reporting longer wait times. Premiums over spot are holding at levels that used to only appear during panic buying. But the paper market shows none of this stress. It continues to trade as if supply and demand are balanced. That disconnect is not an accident. It is a feature of the system. The trap is being set because most investors still use the paper price as their reference point. They look at the spot price and assume that is what silver costs. They wait for dips. They watch charts. They believe they can buy physical silver at any time for a small premium over spot. But that assumption is based on a system that worked when physical and paper were tightly linked. That system is unraveling. What is replacing it is a two-tier market. One tier is for institutions and large buyers who can source metal directly from refiners or negotiate allocated storage. The other tier is for retail investors who buy through dealers and pay whatever premium the market will bear. As physical silver becomes harder to find, the second tier will face higher costs, longer delays, and eventually no availability at any price. This is not about a short squeeze. This is not about a sudden price spike. This is about a slow structural separation where physical silver becomes a different asset class than paper silver. The people who understand this early will move before the premiums explode. The people who wait for confirmation will find themselves priced out or stuck in a queue with no delivery date. The trap is not designed to be obvious. It is designed to feel safe right up until it is not. The mechanics of this trap go deeper than premiums and delivery times. They reach into the foundation of how silver is valued and who controls that valuation. For the past 50 years, the price of silver has been set by a system that prioritizes liquidity over scarcity. That system allowed paper contracts to expand far beyond the physical supply they were supposed to represent. It worked as long as most participants were willing to settle for cash. But when physical demand rises and cash settlement is no longer acceptable, the system has no mechanism to adjust. It simply breaks. And that breaking process does not happen all at once. It happens in stages. Right now, we are in the early stage. Most people do not recognize it because the spot price still looks normal, but underneath, the foundation is shifting. The COMEX operates on a fractional reserve model. That means the exchange holds a certain amount of physical silver in its warehouses, but the total number of contracts representing silver claims far exceeds the metal actually available for delivery. This is legal. This is standard. And this works perfectly well in a market where most traders have no intention of taking delivery. They are trading for price exposure, not for metal. But when the percentage of traders demanding physical delivery starts to rise, the system comes under pressure. The exchange can raise margin requirements. It can change contract specifications. It can limit position sizes, but it cannot create physical silver, and that is the vulnerability. What makes this moment different is the composition of the buyers. In previous decades, physical silver demand came mostly from industrial users and a small community of retail stackers. Industrial users were predictable. Stackers were patient. Neither group put sudden strain on the system. But now, the buyer base is changing. Central banks in certain regions are accumulating precious metals outside the Western banking system. Sovereign wealth funds are diversifying into hard assets. Large family offices are allocating to physical metals as a hedge against currency debasement. These buyers do not trade on the COMEX. They do not settle in cash. They want allocated metal, and they want it delivered. This creates a steady drain on physical supply that does not show up in futures market data. The spot price continues to reflect paper trading activity, while the physical market quietly tightens. Retail investors are caught in the middle. They see the spot price holding steady and assume there is no urgency. They hear about supply concerns but dismiss them as dealer marketing. They wait for a better entry point or a clearer signal. But the signal they are waiting for will not come from the price. It will come from availability. And by the time availability becomes the issue, the premiums will have already moved beyond what most people consider reasonable. This is not speculation. This is exactly what happened in other markets where paper and physical diverged. It happened in palladium. It happened in certain rare earth metals. It is happening now in silver, but the process is slow enough that most people do not see the pattern. The banks and institutions that operate in both markets understand this dynamic. They are not caught off guard. They have access to primary supply channels. They can negotiate directly with miners and refiners. They can lock in forward contracts for physical delivery at terms that retail investors will never see. When premiums rise, these entities are not affected the same way retail buyers are. They continue to acquire metal at or near the spot because they operate inside the system. The trap is not for them. It is for the individual investor who relies on the retail market and believes the spot price represents real-world availability. Here is what most people miss. The spot price is a global reference point, but it does not guarantee access. You can watch silver trade at $28 per ounce on a screen and still pay $35 per ounce for a physical coin. You can see futures contracts settle at a certain price and still wait 6 weeks for a dealer to deliver your order. The price and the product are separate, and that separation creates an invisible tax on anyone who does not understand the difference. You are not just paying a premium. You are paying for the fact that you are outside the primary market. You are downstream, and the further downstream you are, the more you pay and the longer you wait. This is why the trap works. It does not require deception. It does not require a conspiracy. It only requires a system where pricing and access are controlled by different mechanisms. The pricing mechanism is transparent. Everyone can see the spot price. But the access mechanism is opaque. You do not know how much metal is moving behind the scenes. You do not know which buyers are locking in supply months in advance. You do not know when dealer inventories will run dry or when mints will stop taking new orders. By the time that information becomes public, the opportunity to act at a reasonable cost is already gone. The endgame of this trap is not a price collapse. It is a market where price becomes irrelevant because access is restricted. This has happened before in other commodities, but never at this scale in silver. The difference this time is the size of the paper market relative to physical supply and the speed at which Eastern buyers are pulling metal out of Western vaults. When a market splits into two tiers, the lower tier does not get a discount. It gets rationed. And rationing does not announce itself with headlines. It shows up as longer wait times, higher minimums, and eventually dealers who stop quoting prices altogether because they have nothing to sell. Right now, most retail investors still have access. They can call a dealer, place an order, and receive metal within a few weeks. Premiums are elevated but not extreme. This window will not last. The mechanics that are tightening the physical market are not reversible in the short term. Mining output is flat, refining capacity is limited, government mints are operating at or near maximum production. There is no surge of new supply coming to relieve the pressure. And on the demand side, the drivers are structural, not cyclical. Countries are moving away from dollar reserves. Investors are hedging against monetary instability. Industrial users are competing for the same metal that retail buyers want. These forces do not reverse because the spot price stays calm. What happens next is predictable if you understand the structure. Dealers will continue to raise premiums as their costs rise and their inventory turns over. Mints will prioritize large orders over small ones because it is more efficient. Retail buyers will face longer delivery windows and higher prices per ounce. At some point, the spread between paper and physical will be wide enough that arbitrage becomes impossible for small players. You will not be able to buy a futures contract and take delivery at a reasonable cost. You will not be able to convert paper exposure into metal without paying a significant penalty. The two markets will be functionally separate. And most people will still be watching the spot price, wondering why it does not reflect what they are experiencing in the real world. This is the part of the trap that hurts the most. It punishes patience. In a normal market, waiting for confirmation is prudent. You watch for a breakout. You wait for volume to confirm the move. You let the trade come to you. But in a market that is splitting structurally, waiting for confirmation means waiting until the problem is visible to everyone. And when everyone sees it, the cost of entry explodes. The people who move early pay today's premiums. The people who wait pay tomorrow's premiums, which may be double or triple what they are now. Worse, they may pay those premiums and still not receive metal for months. The trap rewards early action and punishes hesitation, which is the opposite of how most investors are trained to think. There is also a psychological component. Most people assume that if physical silver were truly in short supply, the price would reflect it. They believe markets are efficient. They trust that price signals contain all available information. But that assumption only holds in markets where the price is set by the people who actually need the product. In silver, the price is set by traders who are holding contracts, not the metal. They are responding to interest rates, dollar strength, and technical chart patterns. They are not responding to refinery backlogs or vault withdrawals. So the price can stay subdued even as the physical market tightens. This creates cognitive dissonance for investors who are watching both signals. They see a tight supply but stable prices and conclude that the tightness must not be real. By the time the price catches up, the physical market is already locked up. The institutions setting this trap are not doing so maliciously. They are simply operating within a system that benefits them. They have the scale to bypass retail channels. They have the relationships to secure supply at the source. They have the capital to lock in forward contracts and absorb short-term volatility. For them, the separation of paper and physical is an opportunity to acquire metal at a discount relative to what retail will eventually pay. They are not trying to hurt individual investors. They are just indifferent to them. And in a tightening market, indifference is enough. So what does this mean for someone holding cash and thinking about silver? It means the decision is not about timing the perfect entry based on price. It is about securing access before access becomes the bottleneck. It means understanding that the spot price is a reference point, not a guarantee. It means recognizing that premiums are not a markup. They are a reflection of where you sit in the supply chain. And it means accepting that the opportunity to buy silver at a reasonable cost may close before the spot price gives you the signal you are waiting for. The question you have to ask yourself is not whether silver will go higher. The question is whether you will still be able to buy it when you're finally convinced. Because the trap is not designed to catch people who act too soon. It is designed to catch people who wait for certainty. And in a market that is splitting in real time, certainty is the most expensive thing you can buy. What are you waiting for that you do not already know?